Hey everybody, welcome back to Everything Money. It's not everybody, it's just you watching at home. Today we're talking about Snap-on. Paul, I am a little bit of I wouldn't call me a gearhead, but I can get my hands dirty. I've changed brakes, I built a motorcycle, I've welded, and Snap-on is the industry.
Didn't your wife almost die in a car accident because the brakes you put on her car failed?
That's not at all. Snap-on is the industry gold standard, Mo, when it comes to mechanics.
Yes, it is.
Their tools are incredible.
Your dad was a big lover of these.
Yeah, I mean, I have Snap-on tools that my dad gave me after he passed away. Well, my dad gave me, but they're from the 70s, Paul. I love them. But anyway, Snap-on is incredible. Paul, I froth at the mouth when I see the truck go by. Every once in a while, I want to just follow it, pull over. You get to walk inside the showroom that is a truck, and you can pull.
Really?
Oh, yeah, you can pull stuff right off. So the truck goes around to shops and sells stuff, and you can pull right up to the I like when they're at the gas station. I'll go walk right in the truck and go shopping. I love their stuff. Snap-on's amazing, and it always probably will be. In essence, we're going to look at the financials behind Snap-on and see if they're in line with the stock price. And this is, Paul, for our normal viewers out there, someone might say, this is an expensive stock, $220. It sounds like a lot. We'll teach you why the price itself doesn't really matter. We'll show you the financials, user A-player system, and Mo will see if people are trading this stock at a quicker pace. I present to you Paul Gabriel, who owns no Snap-on gear, I would assume.
Correct. And I also want to make note, guys, make sure you get the right ticker symbol. It is not Snap, that is Snapchat.
Oh.
So make sure if you're looking at this as SNA, all right? So guys, this is our software. We're going to go through our software. This was requested by our users about a year ago. We started creating the software. It's awesome. More on that later. So Snap-on is a $12 billion market cap. 5-year PE, we want less than 22.5. It's 18.6. Check mark there.
Very nice.
Very good gross margins, by the way. 51%. Ooh-wee. 5-year return on invested capital, 13%. We want it greater than 9%. So check mark there.
Ooh.
So far, 2 check marks. Uncle Seth, there's a dividend yield here of 2.2%.
I like what I'm seeing so far.
Almost double the market. Now, for those of you out there who are new to the channel, dividend is not always secure. Just because they pay it doesn't mean they can afford it. So what you need to do is, you need to look at the dividend right here, and this is what we make easy with our software, and you have to look at the free cash flow and compare them. In this situation, plenty of money from their free cash flow to pay the dividend, so I'm not worried about the dividend going away. Doesn't mean they won't take it away, but it seems very safe as of right now.
Pillar number 3 is profit growth over the past 5 years.
Revenue growth would be better.
Revenue, I always do that wrong. We should just switch them. Go ahead.
So 3.83 to 4.48.
Can you believe I said profit after all these?
Yeah, I don't know why.
1,000 shows. I have
no idea why.
I don't know. I love you. Go on.
So it's a check mark, but I want to make note, guys. There's kind of, before COVID, it was starting to decline. It's very slightly, but it was still declining. Just keep that in mind. Net income is pillar number 4.
Thank you, Paul.
572 million to 789 million. Check mark there. Probably a lot of pent-up demand. Shares outstanding. 57.8 million down to 54. Check mark there. Guys, we want shares decreasing on companies that are reasonably priced because it shows that the company cares about giving you, the owner of the shares, a higher percentage of the company when they buy back their own shares.
Boom, you said it.
It gives you a higher percentage ownership of the company by doing nothing. 5
straight checks, Paul. Keep going. This is pillar number 6. Total long-term liabilities, their debts, divided by 5-year free cash flow under 5. Tell me.
So what we're going to do here, we go to the 5-year average free cash flow that we provide for you in our software on the main page. 695 million. Multiply it by 5. Let's just call it 3.5 billion to be safe. So we want their long-term liabilities to be under 3.5 billion. Why, you may ask? Uncle Paul, please tell us why. Companies with less debt stick around longer. You don't want to invest in a company that has a lot of debt that might go under, and you go from thinking you have a great situation to all of a sudden you have no equity. That would suck. So
I'd like to see his number, Paul, because this is a unique company where their showroom and their delivery truck are the same thing, actually.
Oh, I don't know what that means, but that's awesome.
Go on.
Ooh. 1.54 billion in long-term liabilities. That's less than half what we want to see. So this is a good check mark. It means if their free cash flow is consistent, they can pay off all their debt, all their long-term liabilities in under 2.5 years. That's incredible.
6 straight checks. Let's get to pillar number 7, which is free cash flow growth over the past 5, baby.
So guys, again, with our software, we added this line for free cash flow. And the reason being is free cash flow is cash from operations less your capital expenditures. It's harder to manipulate than earnings, which are driven by SEC rules and accounting rules. Free cash flow is cash from operations less capital expenditures. Now, 5 years ago, 523 million. Last year, $1 billion. Check mark there. So, guys, with the software, what we're doing here is we're trying to teach you, Mo, Seth, and I are all trying to teach you with the software how to look at companies and get a better understanding of financials. This is a no-brainer. You also get exclusive content every day, 2 or 3 videos a day, just for the users of our software. There's over 6,000 of them out there. We have the app, the mobile app. All of this on your mobile phone, take it anywhere. People can talk to each other. You can learn from the other 6,000 people, have discussions. It's super brilliant and awesome.
You can click on the link below and get access to software right now. And as Paul said, there are different tiers. You can trade with Mo, and you'll have access to us, exclusive content. We just love the community we're growing, Paul. And if you feel alone out there, and if these numbers resonate with you, Paul, I love these numbers. You and I both do. It's just really awesome place to be.
It's a great way to understand financials, and it's only 90 cents a day, guys. Literally the cheapest thing you will do in your lifetime, and it'll make you the most money, the highest return. So anyhow.
Pillar number 8, Paul.
So pillar number 8, guys, what we do is we want to come up with a market cap to pay for the company, right? So what we do is we take the 5-year average free cash flow of 700 million, we multiply it by 20. So call it $14 billion. Why 20? We want 15 on a 1-year basis, but if we're looking at a 5-year average that's increasing, we want to apply a higher multiple to it. So we go to 14 billion. Seth, what's the market cap?
12 billion.
12 billion, so that's a check mark. So right now the company's market cap is less than the multiple we're going to pay. Does that mean go out and buy it? Pump the brakes.
Oh, no.
Pump the brakes. We have, I believe, the 8-pillar tab here that comes with the software. It's an 8-pillar stock. Doesn't mean you automatically go out and buy it. We also have what's called the stock analyzer tool, which we'll go through after Mo's done, where we're going to input some estimates and assumptions, and it'll tell us what we should pay for the company based on the assumptions of revenue growth and profit and returns we want.
I get too antsy and trigger happy, Paul. I see them 8 pillars. How could it be any better? I love what we're seeing here with Snap-on. I love the company too. You know, that really counts in my book.
Yes, and you have a bias towards that.
That's true. That's what I'm trying to say. Yes, I got Snap-on. I love it. I love the truck. Mo, are people trading this in the Bitness Nation, that upper elite tier of traders in our community? Go ahead, Paul.
So let me show
Mo,
you.
Your name's Mo, actually. Go ahead.
Yes, it's Mo. Let me show you 3 things before we go over and look at the daily chart, because there's things I like over there. Right now you're running into the 100-day moving average, and you're really struggling to get through that. You have an upside down hammer, which can basically mean you can move down. In stock price, it's a negative trend. Now, if you look over here, you have not touched average volume for how long? 10 days, 10 trading days, something like that? That's another thing to look at. Also, your bid and ask spread is about 14 cents. So this is a very tough stock to be trading right now from a swing trading perspective. Now, let's look at a day trade. It's actually looking pretty decent. I mean, you're at a support level right here, and I don't think you're really going to go any lower.
You said day trade, Mo?
I said swing trade. This is a long-term chart.
Oh, thank God.
Yeah. So look at your overall trend. You're coming. I mean, you're moving towards that sweet spot. You've really probably bottomed out here. You have a really nice support level. I mean, and there's really no resistance. You might face some resistance at 240, but I could see you getting up to this 260 area. This is a really good-looking stock. It just needs volume to come into it. So this is definitely something that you want to put on your watch list. If I was you, this is a watch list stock, and I think I'm going to put it on the Bid and Ask Nation watch list. And if you want to join the Bid and Ask Nation, and this interests you, for another $1.30 per day, you're going to get the software. You're going to get everything that we give out at Everything Money. Plus, you're going to get exclusive content with me and all of the training series videos.
What would trigger that gasoline we need to get this cooking? I mean, I know you say volume, but what would trigger that?
They have, what I'm hoping is that this E right here, that means earnings. Earnings is on Thursday. I'm hoping that something comes out that gives them that little bit of boost. Usually news kicks these things off, you know.
Yes.
So I'm banking. Hopefully we get something there, gives a little bit of boost, gets this thing moving towards that 240, 260
Well, he's getting good over there, Paul. You see him?
Well, I think you're getting good too, Seth. Seth has some good questions, isn't he?
That was a good question.
Yeah,
that was a really good question.
I'm drawn to this. I'm thinking about dumping all those magic cards and getting into this, Paul.
Come on.
Well, we've talked about this.
Listen, don't drop your magic cards completely. Maybe you drop 80% of them.
But imagine if I could cuddle up with Mo in the morning.
Wait a second, aren't you always in the bathtub in the morning?
Well, he can join me. It's a big tub, Mo.
Are we going to do a live stream sometime with Seth and Mo right there from the bathtub?
I certainly hope not.
Your tub.
The tub's small.
I'll be in the tub. You'll be next to me pouring me champagne.
That's fine by me. Grapes?
I'll put the grapes, you do the champagne.
Please do. Show us the stock.
I'll have Beth
So guys,
him with a
we created a stock analyzer tool because we just looked at the market cap and we said, hey, could it sell for 14 billion? Let's buy it. No. We want to sit there and look at assumptions on growth rates because growth rates will drive so many things. If a company is growing at 10% a year versus another company is growing at 2% a year, you should pay a higher multiple. You should pay more for the one growing 10% a year. Why? Because it's going to grow faster. You're going to drive more profit to the bottom line. So, stock analyzer tool. I did 7-year analysis and I did 2 assumptions. You can do up to 3 assumptions. I put 2% and 4% revenue growth. Put 0.5% buyback to 1.5%. Profit margin 13 to 15. You guys look at my assumptions here. I always do 12.5% return. And the reason being is, as a value investor, 12.5% kind of like my margin of error, my margin of safety. So versus 10% what the market does. The stock's at 222. I hit analyze. Now, guys, remember, according to pillar number 8, we should buy this company right now.
I want to buy it. Let's go.
Stock analyzer tool says, pump the brakes there, Sethi.
Oh.
We need a significant pullback here. High side 190, low side 120. So, you have to sit there and say, what's the stock worth? It's probably more like 150 to 190 or 150 to 200. So it's not far off, but you have to decide. It's only numbers, guys. Every investment is the present value of all future cash flow. This is the future cash flow of the next 7 years on my assumptions. But you can change these assumptions. Let's say you sit there and say, oh no, they're going to grow 5 and 8% a year, and their profit margin is going to be 15 to 17%. Now what does it say? Buy the company all day on the high level. Yeah, great. It's all about changing your assumptions, right? But don't change your assumptions to make the deal work. Make your assumptions based on a reasonable level and being conservative. That's what great value investors do.
That was really well said.
Oh, thank you. I was off the cuff.
That's Snap-on. I am sad now because I was all frothy about the 8 pillars. And then you gotta make me pump the brakes, Paul. That's our whole show. Is just pump the brakes on everything till I can't wait for the days that everything crashes and everything will just be like an amazing buy.
Well, we're gonna be. That's the thing. Right now, our biggest criticism is you guys don't want to buy anything. In the future, it'll be you guys want to buy everything. It's like, well, yeah, it's just that's the way it works sometimes.
Yeah.
You guys say everything's a good deal. I'm like, yeah, but the stock keeps going down. Well, that's what happens. Look at Alibaba. We were saying buy Alibaba at 184. It went to 138. Now it's at 1 step. Still a buyer.
Yeah.
Anyways.
That's our take. Go stop the Snap-on truck when it drives by and get yourself some gear. Go fix something on your car. You'll be a better person for it, right, Paul? You haven't changed a tire in your life, have you?
Oh, yeah. I've done it twice.
Nice. Your oil? Oil? No.
Oil, no chance.
Final the thumbs up. Join the community. We'll see you on there. See you next video.